Hey traders, Clifford back with another video on trading the charts. So today I wanted to take a step back and go over what I believe is one of the most overlooked aspects of trading, and that is money management and why it's so important. So with that being said, let's get started. Okay, so money management, where do I start? Um, if you're new to trading, this may be probably one of the most important videos you ever watch. If you're seasoned trader, then this is probably things you already know, but never hurts to get a review, I guess. um, Money management is, I believe, what separates people who are, trading part-time or trading as a hobby to that goal of, full-time trading and, long-term success, right? I am not a full-time trader as of yet, although that is my goal. And it's a long road, I mean, I'm not going to sugarcoat anything. It's there's a lot to learn, especially if you're new to trading, but over time you could definitely be successful at it. um, the thing with money management is it's very overlooked, especially like new traders. They don't realize how important it is to manage your risk. And this is similar to I was reading an article actually earlier today about poker, and the guy who posted, the trader who posted the article, made a good point. Like, trading is sometimes compared to poker, because like just like people who play poker, they're not going to risk their whole bankroll on one trade. As a trader, we have to manage our risk as well. So the first thing I'll say about money management is, for me anyways, when I was I've been studying the market for about 20 years, trading for that period of time, and I've blown many accounts. I've actually had very good profits as well. So I've seen both sides. And what I can say is that the biggest thing that I learned, as that I didn't learn, sorry, when I started in the beginning, is that, I would always look at it as, okay, how much money can I make on this trade, right? So like, here's an example. I'm looking at the euro and I'm like, oh, this thing's breaking out. Perfect. I could buy right now. I could buy right here, and I could make $1,000 if it makes it to 108 right now. I believe the dollar's in a downtrend. This is going to work out great. You know what? I'll just, if I'm wrong, maybe I'll lose a couple hundred. I'm going to put my stop, here or whatever, and I'm going to put my limit here, and I'm going to make $1,000 on this trade. This is great. Let me pull the trigger, and boom, what happens? I pulled it as a new trader. All of a sudden, things starts moving against me, and I'm like down, like, $200, $300, $500. Finally, I take my loss, right? Because I'm like, okay, man, that didn't work out. Occasionally, you're going to hit your winners as well. Most traders, successful traders, are going to win at least 50% of the time. Technical analysis can put the edge even harder in your favor. But that was a hard lesson for me when I started blowing accounts. I learned that, you know what, I'm looking at this the wrong way. So the biggest advice I can give, if you're new to trading, or if you're a seasoned trader, you probably already know this, but the first rule I would say that's most important: never look at a trade as how much money you're going to make, because no trade is guaranteed a successful outcome. This is a risk management business, and you need to start looking at it as, how much money can I afford to lose on this trade that I'm considering taking right now? Because the truth is, losses are a part of this business. And whether it's a hobby for you, or whether you're a part-time trader, or if you're, I mean, well, if you're a full-time trader, congratulations, you've made it to the goal that, not everyone achieves. Um, but yeah, that's what it is. It's risk management. And when it comes to risk management, there's actually, there's a pretty strong rule that professionals use, and that's this one right here. This is a really good website, by the way, babypips.com. If you're new to the Forex or new to money management, they have a really good course here, that I had taken over the years, and it's free. So as you can see, the 2% rule. This is one of the most famous rules in all of trading. If you've never heard this before, then definitely you want to know this. Never risk more than 2% of your account on any given trade. And this is a rule that professionals use actually. Um, so what is 2%? Well, I mean, if you got like $10,000, what is it? 200, right? If you got like 5,000, what is it? Like I don't know, less, right? So, but 2%. Why 2%, right? Well, the truth is that this is why. So he puts a chart here. 2% versus 10%. Let's say someone starts with $20,000, right? He's giving this as an example. If I lose 2%, I'm only losing 400 on the first trade, right? However, if I was risking 10%, I just lost $2,000. I lost 10% of my account. And and as you see, let's say you hit a losing streak, because the truth is, even if you're the one of the best technical analysts in the world and you're an awesome trader, the truth is you're going to be wrong at least 50% of the time. Um, I mean, you're going to hit a losing streak. It's going to happen. Now, you're going to have winning streaks too, and it's great when you can ride the wave. That's what we all want. But in order to make it to those future waves, you got to be able to survive the storm, survive the losing streak. Well, if you're risking 10% at a time, and you got, I don't know, 10 grand, 20 grand, you're only going to have like 10 shots and that's it. It's game over. You're done. And I've been there, so I know how it feels. Um, but if you're risking 2%, look at the difference: 20,000, 19,600. As you see, your money is going to survive over the long term. And that's the difference. When you hit a losing streak, you're going to survive that losing streak instead of, in the end of the day, look what happened. A guy who had a losing streak at 20,000, right, was risking 10%. He may have had some winners, but he lost like 97% of his money. Whereas the guy who only risked 2%, he's still got a lot left. So and this is also called drawdown. You may have heard the term drawdown before. That's how much money you're losing before when you hit the low on your equity, before you finally turn it around and start to turn it to profit. And this is another table right here that shows you, as you lose money, what's required to actually make it back. So like you lose 10% of your account, you now have to make 11% back just to break even. You lose 20%, 25, 30%, 43, 40%, 67. And look what happens. You lose 50% of your account, you got to make 100% just to get back to break even. That's crazy. So definitely learn the 2% rule if you've never heard of that. I mean, some traders may be like, well, 2% is like a little low. Okay, I mean, everyone has a different risk tolerance. You could go 3%, 4%. I wouldn't go, me personally, more than 5%. I mean, obviously, if you think it's going to be a really big trade, then yeah, you might increase it slightly, but most of the time you want to stick to that rule. So those are the first two most important things I would say. Always look at a trade as how much money you can afford to lose on every opportunity, and never risk more than 2% of your account. If you're trading with a very small account, then you may have to wait till you can get up to the. Actually, depending on which markets you're trading, you could trade some of these markets, even small accounts with 2%. You could trade options, or you could trade smaller lot sizes. There's always ways of doing it. So that's the second thing. And the final thing I'll mention in money management and being able to allow yourself to survive these storms of trading and these drawdowns in trading is a risk reward ratio. And this is most people who've traded long enough have heard of this. Risk reward ratios basically are very important in trading. All it means is basically how much money are you making versus how much money are you losing. That's pretty much all it is. An example is if I risk $1,000, right? And I have 10 trades. Let's say I'm right 50% of the time. Well, if I'm risking 1,000 to make 1,000, that would be called a 1-to-1 risk ratio. I'm risking the exact same amount that I'm profiting. So if I did 10 trades in a row and I lost on 5, basically uh, I lost 5,000, but I made 5,000. So I didn't get anywhere. I wasted my time. I broke even. Okay. However, if I change the risk reward ratio from 1 to 1 to 2 to 1, now it's different because I'm risking 1,000, but or sorry, 2 to 1, or well, in this example, he's using 3 to 1. If I risk 1,000, but I make 2 or 3,000 when I'm right, now you see the difference. Now I could lose 50% of the time and still make money because look, in this example, he lost 5,000. He still lost 5 trades at $1,000 risk, right? But because his profit target was triple what he was risking, he ended up, uh, you know, making 3,000 on each winner. So he made 15,000. So that's very important. Make sure you're using a high risk reward ratio in all your trades. I'll do one example of that, and then I think I pretty much covered everything, the basics of money management. So let's say, and by the way, TradingView is very good because they have tools for this. There's a tool they have here called the long position or the short position, and this is really good for risk ratios. So let's pull up a market here. This is the euro I'm looking at. I mean, this could be a stock, this could be a currency, this could be a commodity, it could be a crypto, whatever you want to trade, doesn't matter. I'm using technical analysis just to whatever, an uptrend here. Well, let's just say I bought the euro at a good time. Let's say I bought it somewhere around here and I open this tool, right? The long position tool. So let's say I'm a really good trader and I got in, I don't know, I got in at a really good price, let's say, like before it was close to the bottom, whatever. So, I got in like maybe, I don't know, I got in like maybe around here. So now I set my stop loss, right? So let's use the example of using a stop loss. So let's say I'm gonna use a 50-point stop loss or a 50 pip stop loss in if you're a forex trader, it's 50 pips or 50 ticks if you're a commodity trader. If it's a stock, I guess it would be either 50 cents or whatever you're looking at there. So here you go. So I bought in where did I buy in here? Yeah. Yeah, okay. So I bought in here, right? So I'm risking $50, right? And I'm risking 50 ticks, which is let's just say I got $10,000 on the account and I'm risking 50 ticks, which is, let's say that's $200. I'm risking 200, right? So now I set my target. And you see as I move this, right? It's telling me my target. So if I'm risking 50 ticks to make 50 ticks, that's 1 to 1. And you see how it says right here, risk reward ratio 1. I don't want to do that because again, we just went over that in this example over here. If I'm wrong on 50% of my trades, which no matter how good of an analyst you are, I mean, you're going to have losses at least 50% most of the time. I don't care if someone tells you, I got the best indicator in the world and it's 80%. I'm sure you're going to have at least 50% of the time losses. And if that's the case, look what's happening. Again, you're risking $50 or 50 ticks, right? Oh, sorry, you're risking $200, sorry, and you're making 200. Again, 5 times out of 10, you win 5, you lose 5, you get nowhere. You break even. However, as soon as I raise it up here, now look what it does. Risk reward ratio 2 to 1. See that? Now I'm risking 50 ticks, but I'm making 100 ticks on my profits. Still risking the same amount, $200 on a $10,000 example. 9,800 is, $200 is my risk, but I'm profiting. I'm risking 50 ticks. I'm profiting 100 ticks. So I'm risking 200, but I'm profiting 400. If I raise it even higher, look, it'll go to 3 to 1. So as I use this tool, I can estimate where is the best place to get out. So the bottom line is definitely use your risk reward ratios and always risk 2% of your account and always look for minimum 2 to 1 risk reward ratio. That is the best advice I could give for any new trader out there. And if you're a seasoned trader, I would think you would agree with me, but unless you use different risk reward ratios and you have a different system, every trader is different. So these are just general guidelines, really rules of the industry that most of us have learned over the years. So I hope that helps those of you who may be new to trading, or possibly a refresher for those of you who have been trading a long time. And again, whether it's stocks, commodities, cryptocurrencies, Forex, futures, all the same rules apply. So if you like this video, feel free to like, subscribe, put your comments below. Look forward to seeing you guys in the next video. And as always, my friends, trade what you see on the charts. Trade well.